let's talk about the decision to accept a special order in our G&G landscape setting. To set up our example, consider Jocelyn. She's a flower manager at G&G, and she receives a call from Ryan, a manager at Remillion Homes. It is the middle of the summer season, and Ryan would like to purchase a large number of annual flowers for early autumn plantings. So in thinking about the two options that Jocelyn has, she's basically comparing a normal sales to what Ryan is offering. So let's distinguish between those two options. Normal sales and Ryan's offer. In terms of revenues, we normally sell each unit for $10 a piece. Ryan is offering $6. The variable costs that we incur per unit are $4. And that would not change based on Ryan's offer. We're not changing our product. Ryan's just looking for a special price. So the $4 stays the same regardless of what option we choose. And the fixed costs, when we think about those on a per unit basis, those are $3 per unit. So in thinking about our profitability perspective, we normally would earn $3 per unit via a normal sale. And Ryan's offer is actually losing us $1 per unit. So on the surface, Jocelyn would tell Ryan, no thank you for this special offer. It's too low of a price to cover the costs that are normally being incurred for each of the units that are being produced. To produce and sell these units to Ryan would incur $1 loss per unit. But let's apply this notion of relevant information to this sales-oriented decision. So first off, let's apply this notion of relevance to the fixed costs in this scenario. Where does the fixed cost per unit really come from? Well, that has to do with the capacity to produce these units in a given time frame. The $3 per unit is an average amount for each of the units that Jocelyn could produce. Let's say that Jocelyn in this time frame could produce 5,000 units. That means that the total fixed costs that are required to produce those 5,000 units would be $15,000. $3 per unit multiplied by the 5,000 units, that's $15,000. The $15,000 was actually our starting point. We knew what the fixed costs were going to be. Divided by that number by the total number of units that we could produce to come up with that $3 per unit. So our capacity to produce these units is 5,000 units, and we spend $15,000 in fixed costs in order to yield that. And that's where our $3 per unit in fixed costs come from. Because these costs are fixed, we're going to incur this $15,000 no matter what. So really the fixed cost per unit number is somewhat misleading. It makes us think that we're going to incur $3 for every unit that we produce and sell, when in fact, even if we were to produce nothing, we would incur the entire $15,000 in fixed costs. So essentially the fixed costs on a per unit basis is irrelevant to any of the situation here. We're incurring the equivalent of $3 per unit for all 5,000 units that we could produce, regardless of who we sell to and how many we produce. So that translates the two versions of our situation into a revised number. And we're focused on the revenues minus the variable costs or contribution margin that we get from each of these scenarios. A normal sale earns us $6, $10 minus the $4 in variable costs. And Ryan's offer, if we were to pursue it, would yield $2 in contribution margin. Again, now we've eliminated the fixed costs from consideration because those costs aren't changing regardless of what we do. But now we focused on the contribution margin, and that still looks different between the two situations. The $10 minus $4 for a normal sale gets us $6 in contribution margin, and Ryan's offer only gets us 2, Ryan's deal is still poor. But now there's one other aspect that we need to take into account, and that is that capacity that we currently have. Again, we identified a 5,000 unit capacity in this scenario. Let's look at 2 situations that influence whether or not this decision is a good one. If we are currently planning on producing all 5,000 units and selling them to existing customers, then essentially we would incur an opportunity cost in order to sell to Ryan. What would that opportunity cost be? It would be the $6 in contribution margin that we earned from a normal sale. This means that if we were to accept Ryan's offer, we would give up 1,000 units of normal sales at $6 a piece in order to achieve 1,000 units of sales to Ryan at only $2 a piece. That's a losing proposition there. Perfect example of opportunity cost. Again, we currently have an option to sell all 5,000 units in this scenario. By taking those away from our existing customers and selling to Ryan, we would incur a cost, the opportunity cost of choosing to sell to Ryan. But let's say there is an alternative scenario. And let's say that currently we only have plans to produce and sell 4,000. That means that we have excess capacity of 1,000 units. That means that we are not currently selling these 1,000 units to normal customers. And so for these 1,000 units, this $6 is no longer relevant. And so that has a different implication for this decision. The $2 that we would earn for each of these 1,000 units that we had not planned on producing and selling is actually money left on the table. Even though Ryan's offer of $6 per unit is less than what we normally get, we're not cannibalizing existing sales in order to produce and sell to Ryan. So in essence, the $2 that we earn from Ryan, even though it's smaller than what we normally get, is actually beneficial for the 1,000 units that we're currently not selling to existing customers. So, what was relevant here was the level of capacity that we are planning on using. To the extent that we are using all of our capacity, or we did not have excess capacity to fulfill Ryan's needs, we would incur the opportunity cost of pulling normal sales away and selling them to Ryan at a cheaper price. But given in the second scenario that we weren't using that capacity to begin with, then the normal contribution margin that we were earning is not really relevant because we had 1,000 units of excess capacity that we weren't earning the contribution margin on. That means that Ryan's deal of any amount above and beyond our variable costs would earn us additional profits. And ultimately, choosing to accept Ryan's offer would benefit the firm. So let's have a checkpoint to make sure that we're all on the same page on this analysis. So are there other concerns about this decision that we need to be thinking about? Of course. One is the precedent that we set by accepting a lower price than normal. If other customers caught wind of our ability to change the price in response to a customer's request, they might hold out for a better price in the future. And of course, that has some negative implications for our profitability. On the flip side, it might be that accepting Ryan's offer in this case might open up the door to future transactions with him. And if he's a potential large client, then perhaps accepting this price now leads to future profitability with future transactions with him. So these considerations would, of course, come into the decision process. They're more strategic and more qualitative, and they would be considered in accordance or in aligned with the financial perspective that we adopted in our example.